You get paid. You cover the taxes, pay the utility bills, and whatever remains lands in your checking account. It is a common assumption that these savings sit locked safely in a vault, static and waiting for you to swipe your debit card. This skyline is essentially a monument to credit. Every pane of glass and steel girder was financed by loans sourced from the collective deposits of millions of accounts, providing the massive capital required to build modern infrastructure. Because the modern economy relies on this continuous cycle of borrowing to fund expansion, the sudden withdrawal of these idle deposits would cause credit to seize, effectively paralyzing global productivity. The rules of this flow are set by central banks, like the Federal Reserve. They act as the system's ultimate authorities, dictating the exact volume of money allowed to circulate through the nation. This diagram shows their primary lever, monetary policy. When growth slows, central banks cut interest rates to make borrowing cheap, which forces more cash into the system and pushes economic productivity upward. Because lower rates create a temporary boom, politicians frequently pressure central banks to keep money cheap, prioritizing immediate economic optics over long-term inflation risks. Commercial banks, the local branches where you bank, serve as the workhorses for this policy. They take your idle cash and actively transfer it to the corporate borrowers looking to expand. These institutions function by expanding the money supply. In many economies, they operate with a 0% reserve requirement, allowing them to issue new loans that far exceed the actual cash they hold in their vaults. This mathematical multiplication ensures a constant flow of capital, creating the very liquidity that defines both modern wealth and national inflation. Beyond your checking account, the system siphons off a massive portion of global wealth into passive pools long before you ever see a paycheck. Pension funds are the heavyweights here, managing over $60 trillion worldwide. This chart shows their dilemma. Standard savings accounts offer yields too low to fund retirements, forcing these funds to hunt for 6 to 7% annual returns across global real estate and corporate debt. Insurance companies operate on the same logic. They collect premiums for decades, building a massive hoard of cash that they aggressively invest in global markets while waiting for the rare disaster to strike. Even if you have never traded a single stock, your monthly insurance premiums and retirement contributions make you a significant, if silent, player in the global markets. For most people, the entry point into these markets is a mutual fund. These allow retail investors to pool their money and buy into a broad, diversified basket of stocks and bonds. Hedge funds are the exclusive, loosely regulated counterparts. They are strictly reserved for institutions and ultra-wealthy individuals, giving them the freedom to place aggressive bets on anything from oil prices to election outcomes. Their primary tool is leverage. By borrowing massive sums of money to amplify their initial capital, they can place bets that are far larger than their actual holdings. Despite the high fees and complex strategies, history shows that active hedge fund management routinely fails to beat a simple, passive market index. While retail funds prioritize steady wealth preservation, these elite funds exist to gamble aggressively with borrowed money against the volatility of the system itself. Investment banks act as Wall Street's matchmakers. They are the ones who orchestrate multi-billion-dollar corporate loans and prepare paperwork for massive companies to go public. These bankers often funnel capital to private equity firms. These firms operate like corporate house flippers, using pooled money to buy entire companies, overhaul them, and flip them for a profit. They frequently use the leveraged buyout trick. After buying a company using mostly borrowed money, the private equity firm moved that debt onto the acquired company's own books, insulating the firm from the risk of a potential bankruptcy. Venture capitalists represent the final tier of this gamble. They pitch their ability to spot the next tech giant to pension funds and insurance companies, asking for billions to spray across high-risk startups. This follows the power law. Venture capitalists expect 90% of these startups to fail. Their entire business model relies on a single massive success, returning 10,000 times the initial investment to cover the losses of the rest. In 2004, Peter Thiel's fund put $500,000 into an unproven network called Facebook. While most of their other bets that year vanished, that one check eventually returned over $1 billion. At this level, profit is generated by engineering extreme risk and utilizing pooled public capital to extract outsized personal gains. Tracing the full cycle reveals how every node connects. A central bank rate cut provides the liquidity commercial banks need to lend more freely. Those loans drive the corporate growth that generates the wages and profits feeding back into pension funds and insurance pools. These massive passive pools then hand that capital to the riskiest players, private equity and venture capital, to fuel the final gambles of the system. The system's fragility lies in this interconnectedness. Excessive leverage and greed at the top can cause this entire web to shudder, potentially threatening the stability of the commercial banks holding your personal savings. Every paycheck you earn and premium you pay serves as a vital component of this machine, keeping the global economy in constant motion.